tomorrow morning I'm gonna start to have a long road trip here in China. We'll be like drive half a day and work for the other half day. Yeah, you can't believe it because it's more than 6,000 kilometers.
No way. Sounds really interesting. I'm a big fan of road trips, by the way. And the longest road trip I did was 3 days.
3 days. Only 3 days.
Congratulate. Only 3 days, exactly. So
it's like an outing here in China if you just go for a road trip for 3 days.
And is it safe to cross all the country 10 days? Is it how safe is it? Sometimes seems to be also very rural and empty, the area. So
not only is it safe, but I drive a Tesla, and along all the way there are only like 4 stations that I have to charge without a Tesla supercharger. But I use like NIO or other like the EV companies self-owned stations. Okay, so like I charge every 350 kilometers. So like out of the 18 or 17 times, only 4 times I have to charge elsewhere.
So you have everywhere on all the roads you have superchargers, and most of the time.
Yeah.
That's wow. It's almost like in Europe.
But I'm also going to do something more adventurous because it is so close to Kazakhstan. So I'm trying to find a way to drive to Kazakhstan.
Is that possible?
Yeah. So I've checked on like Chinese social media, like the Chinese version of Reddit. So there are people who share their journey, like they traveled from basically my province to France, self-driving. Yeah.
So I just learned that my insurance has a global coverage.
That's great.
So yeah, I could go the whole route, and that will be longer than 10 days. But you mean
the whole Europe?
Because not only whole Europe, I could go like let's see the way to drive. It will be probably.
I mean, if you go east, then you go past like Austria maybe, and then
Europe again, and then
Asian
Turkey,
countries.
and then probably Iran, and then Turkmenistan, Uzbekistan, Kazakhstan, and then Xinjiang.
Yeah. There was also a Netflix documentary, like 2 German guys started from Berlin. They just biked from Berlin to Beijing.
Yeah, biking is famous. But road trips with a car or Tesla, it's not very famous. That's very, very unusual.
Yeah, great. So I'm so happy to have this podcast with you, Ertan. Hopefully, like these questions aren't quite boring to you.
No, I don't think so.
Great. So welcome to the YUVC podcast, friends. Here at YUVC, we ask senior VCs or LPs or people who know VC very well, why you venture capital, and we rethink with the guest the venture capital industry. So today we are joined by Ertan Can, founder at Multiple Capital, which is based in Luxembourg. And also he is an investor of some of the highest potential European micro VCs. Hi, Ertan.
Hi, YC. How are you?
I'm very good. So as which city are you actually based in Luxembourg?
In Luxembourg. So the city, the main city in Luxembourg is also called Luxembourg, and it's also the largest city in the country, which is not a large city in the end. It's just I think 170 or 180,000 population.
Yeah. Now you made my first question look silly already.
Many people don't know it, so it's totally okay.
Okay, great. So Ertan, when I went through your LinkedIn profile, so I noticed that it was blank like before 2020. So I was really curious about like your journey, your upbringing before 2020. So what happened and how does it relate to your journey at Multiple Capital?
So I was born and raised in Frankfurt. Frankfurt is a city in Germany, which is mainly around banking and finance and asset management. And I studied finance and business or finance and law, and then landed in the banking industry, banking/asset management industry. The first jobs were in traditional asset management firms, larger firms. I think my first job was at JP Morgan, and then I went to a subsidiary of Societe Generale. But most of the time I was involved with the fund business. So back then, in the early 2000s, It was more mutual funds and not private equity or venture capital funds. So I spent almost 10 years in that business, and then I decided to do a very late something like an executive MBA. So I wanted to change. You can call it direction, or wanted to do something different. And so I would not recommend to do it, by the way. So my recommendation is skip it, but it helped me to really stop and focus on something new. So that was like I think the only help. It cost me 50,000, and it's a high price tag for this kind of decision. But in the end, it helped to make a decision to stop what I was doing and focus on something new. I started a company which failed, and then I was asked by a friend who worked for a family office if I want to join them. Long story short, I joined this family office, and I was the person to do venture. So I've never done venture before, right? So it was 2012. I started to invest in early stage companies, mainly in Germany. A year later, and almost 20 investments after, I went back to the family and said, I don't think it's a good idea. I don't think that I'm the right person to invest early stage companies.
What kind of family offices are they?
So we tried to bring a vertical focus, which is travel tech, into the strategy. But still, I think if we would have continued to invest directly, it would be mostly travel tech. And still, it's like, in my opinion, it's too narrow. So either you want to really be a strategic investor, which we were not, or you want to benefit from the asset class, and then it's not a good idea as an unknown family office, small family office, with someone who has literally no experience in investing into tech companies to invest in early stage tech companies. I think the adverse selection risk is so high that it just doesn't make sense for most of the people. So I recommended that. I went back and said, it doesn't make sense, and we should stop doing it. And I said, okay, thanks, makes a lot of sense, but, what should we do with you now? I mean, should we fire you? And I said, no, I have another idea, and which was, I suggested to do a pan-European fund of fund. Instead of investing into early stage companies, I suggested, why don't you let me invest in funds instead? Because that's like where I'm really coming from and where my background is. And within that year, I really met a lot of VCs for co-investors, and I understood how a VC fund really works. So I liked the idea much more. And back then, like today, 11, 12 years ago, there was no one else doing it on an international level. Right, so no one from Germany went to Finland and knocked on their doors and said, I'm interested in to invest in any of the funds or look at the funds. So I thought it's a great opportunity. I convinced them to give me, money to do that, and that's what I call my first portfolio today. So I started really traveling across Europe and investing into what I call today micro VCs. I think the term was not really invented back then, and most of the funds were not really what we would call micro VCs. They were early stage VCs.
So how large was your first close? What kind of ticket did they give it to you?
So I deployed 8.5 million euros over roughly 5 years in 10 funds. That was like the first portfolio of investing, and it's an exceptional, well-performing portfolio. This first one. It's also in one of the best decades in venture in Europe. To be honest, that's also. But we hit some huge outliers, and interestingly, like 50% of the funds we invested in were really considered what is top decile, and I think that was an exceptional portfolio with the first. But it's a small portfolio. It was 8.5 million. We invested on average something like 800K per fund. But interestingly, again, I've said it many times, this kind of 1 million check for small emerging managers from a private investor is relatively significant. Back then, it was relatively very significant, and today it's still significant for many of the smaller funds.
And why is that significant? Because I know that VCs raise from like large insurance companies or pension funds or some high net worth individuals.
I think in the European ecosystem, there are not a lot of institutional investors. So insurances typically don't invest into what we call micro VCs, right? So, by the way, insurances and pension funds in Europe, most of them don't even invest in venture. So there is, for most of them, there's no venture allocation at all. Not only micro and emerging, I mean, even the established VC funds can't raise from pension funds in Europe. So that's why usually they're not real investors for that asset class. Now,
Understood.
you have the largest fund of funds in the European ecosystem are public fund of funds. So if you are raising public money, then yes, you get larger checks. But if you are looking at private money, most of the private money is individuals, small family offices, sometimes corporates, but the checks are not the largest, right? So most of the individuals invest less than 1 million. Most of the family offices invest something around 1 million, sometimes 500,000, sometimes 1 or 2 million. And you don't have a lot of family office investing into emerging managers or micro VCs. So it's, again, like it's a riskier bet for them, right? So it's like an unproven new manager, smaller fund. Small always is considered as more risky, kind of. The teams are smaller. So lots of reasons why a traditional family office would say no. So what's left is really high net worth individuals, tech founders who exited, other VCs who are larger, and then back other VCs. So that's the typical, and then some, few fund of funds who really do micro VCs in the market.
Back when you started, so there weren't many investors like yourself. And also you mentioned before, like you didn't even call them micro VCs. And so when did micro VCs come to a thing that you defined clearly?
So the term was already used in the US a lot. I just took it over and used the term more and more. But in the beginning, in the first portfolio, we had also 2 funds above 100 million, for example, which is in the US still considered micro VC, kind of. They have a new term now, nano VC, for the kind of for the micro VCs that I invest in. It's a new term called nano VC in the US, at least. So, but back then, no one talked about that word micro VC. So it evolved, and at some point, more and more people in the US talked about it. More VCs talked about raising a micro VC or doing a micro VC fund. And also, I was talking more about that, subsector of micro VCs when I was publicly talking about what we do. So we had an early understanding of why we want to invest in small funds and why small funds make a big difference. But the term micro VC, I think we started using in Fund 2, in the second fund, which was a multi-LP fund. Started that in 2018. And it's the first time that I used the term micro VC or investing into micro VCs. And the tendency was then that we are going smaller on average. We just had a much larger deal flow of smaller funds compared to 10 years ago, where the number of deal flow was much, much less. And many of the funds who raised capital raised also from the EIF or from the public LPs.
So I actually came across a few articles published by Sifted, or these kind of European venture capital media. So they would collect or publish an article at the end of each year. So in 2023, these 50 funds or these 50 micro funds just raised their money or finished their first close. So was this kind of list complete in your eyes?
No. No. I mean, I think it's one of the things that I'm trying to bring some transparency into it. There is no complete list of funds because it's an intransparent, inefficient market. You don't know how many funds at the moment in Finland start to raise a fund, right? And many of the ones that start to raise a fund don't even know if they are going to raise the fund. So, and many funds don't make it public. So what we count today is probably something like 800 funds a year that try to raise a fund, that are in the market raising a fund.
And
not all of them will be successful.
Right.
Exactly. And not all of them, I mean, the funnel for first time or emerging managers is much larger than for second or third time. And there's also statistics about, if you raise the first time fund, only 50% of them will raise the second fund, and only again 30% or 50% of them will raise a third fund. Something like that, right? So established funds, the number of established funds are much smaller compared to the number of new funds who want to enter the market. That's why, in our opinion, our job is to look at many more funds than the typical fund of fund that invests in established managers. Many of the established fund of funds invest into the same funds every year, again and again, right? So they've selected one brand and they do fund number 9, fund number 10, fund number 11. So they don't even look for new funds. Whereas we try to screen the whole market of what we call micro funds, and most of them are emerging managers, and that's why they are new to the market. So that's maybe a big difference. Yeah.
So why did they just stop doing the real work? Do they think like I've got good enough VCs in my portfolio and I just lay off some of my sourcing team?
I think they don't have to lay off anyone, because it's a very comfortable situation. If you are a larger established fund of fund investing into large established funds, you typically raise larger amounts from conservative larger LPs. Means it is a very comfortable situation if you don't have to look at the whole markets, invest in 10 to 15 managers that you already know. So I think it sounds for me like an easy job, right? But it's a comfortable situation, so they don't need to there's no need for urgency. They don't need to change the model, right? So their LPs are happy. It takes decades to see if the fund of funds or funds are performing or not, right? But it doesn't mean it's not a proof for performing in the future. So I think that there is a big, in my opinion, misunderstanding, or let's say we have a very different opinion on which funds will perform in the future versus which funds have performed in the past. So we don't think that funds that have performed in the past will be performing in the future, or will be the best performers in the future. And the simple reason for that is every mega performing fund in the past typically has raised much, much bigger funds today. They raised some of them billions, right, which they have to deploy and return. And deploying and returning billions is very different from deploying and returning maybe a 200 million first or second or third fund. But it's a comfortable situation for a lot of participants in the markets. Right. And
yeah, but I would say like before seeing the results in 5 or 10 years, as the AUM gets larger and larger, and then they get like more management fees, at least they feel comfortable right now. And time will tell.
Totally. Time will tell. And sometimes it's, again, a big part of that business, of that asset class, is very intransparent. So even time sometimes don't tell you the real truth because they don't publish it, right? I love two websites. It's from two very large US pension funds, LPs. One is CalPERS and the other one is UTIMCO, I think. They both have to publish all their investments publicly.
Wow.
So you have exactly the name of the fund, the return, how much they've invested, how much they returned, DPI, TVPI. So it's great. It's real numbers. They have to, because their retirees expect transparency. So any fund they are going to invest in, they will publish on their website. If someone wants to have a real sense of performance in private equity, just go to that website and you'll find 300 private equity funds, most of them well-known brands, and you see the real substance, right? Real performance. And but that's the most real that I could find. And for emerging managers, I mean, there is nothing, right? So everyone investing into an emerging manager has to wait 10 years until he really sees some results.
So my question for you is, have you considered to show this kind of transparency?
So we're showing it to LPs who are looking into our fund, right? So we try to show as much as we can in terms of what we believe, why the market performs like that, why smaller funds outperform, how our portfolio performs, but it's always limited. I mean, we are now invested in more than 50 funds, but still it's very limited if you look at the total markets. And we don't receive from the total market, we don't receive quarterly updates, right? It's only the funds that we have invested in, we receive quarterly updates. Everyone else, we just guess based on public data how well the funds are or not. Some of the funds we know they are outliers, even though we're not invested. But most of the funds in VC, and I'm talking globally, not only Europe, are not really performing well. That's part of VC. It's an adverse selection asset class, and it's very important to participate in the few funds that perform well. And what we do at multiple is to increase the probability of being part of those funds and
Yeah.
perform well. Will all the funds be performing well in our portfolio? No way, right? It's like the same thing as when a VC fund invests into 30 companies, you can't expect that all 30 companies will be outliers.
Sure.
Hopefully 1 to 3, like 10% will be outliers, and some will be acceptable.
Yeah. So is it like the similar ratio for thought?
It's very similar.
Yeah.
It's very similar with the difference that the upside and the downside is both limited, right? So we will never have 100x fund. I mean, it happens, but it's super rare, right?
Yeah.
And we will never have, like, most of the time we don't have a write-off, right? So there is no write-off in investing into funds. So even like the funds that are not performing well will be still paying back 1 to 2x, and the best performing funds will be maybe paying back 10x. But we, usually don't have a 20, 50, 100, 500x. Like it can happen in a portfolio of companies. But again, we also don't have like 80% write-offs or something like that.
Yeah. So digging deep into the data and research part, it reminds me of the podcast that we did before with Defiance Capital's Christian Dorfer, who was the past CEO of Sweet Capital. So he published a report called the Unicorn Founder DNA. So he researched like all the unicorn founders in the States as well as in Europe. I mean, it's easier if you look at unicorn companies and founders because like all data are public. But if you like do a similar research on all the VC funds, it's really not doable, I guess.
So our core belief is that we believe in like randomness when we invest. We believe that it's almost impossible to predict the ones that will be the outliers, right? So I think if someone tries to analyze unicorn founders and find the DNA, and maybe if he found the DNA, invest only in founders with that DNA, that's like more or less a guarantee, if that works, to be in the next unicorn founders. I don't think that this works, because if it works, it's like an arbitrage. If it works, then all the money will go into exactly the strategy, and it will be very difficult to access those funders because everyone will try to access those funders, right? It's like very simple, because not only the VCs but also the Carlyles of this world would just back those. If there's data that is more or less safe, giving you this kind of DNA access to the next huge outliers, then super simple. And we get the same question to our, from our LPs when we invest. Like we invest in 30 funds per fund of fund, 10 funds per year. Every time we get a question, Ertan, tell us which are the best 3 funds in your portfolio, and we would like to double down on that 3 funds. We say, like, if we would know which of those 3 funds, which of the funds in our portfolio will be the best 3 funds, we would put all our money into that 3 funds, right?
If you ask me that question 10 years later, I'll give you the answer.
Yeah, you can't know that. That's the reason why we are doing 30 funds. We think each of the 30 funds that we are investing in is a potential outlier, can be a potential outlier. So yes, we could only invest in 3, but we might miss the ones that we think could be, right? So, and some of the 30 will not be outliers. Many of them will not be outliers. So it's all about, again, I think the word is, I thought long about that sentence. It's about increasing the probability of being part of the outliers, right? Increasing, so I'm not guaranteeing of being part of it. I'm just increasing the probability of being part of some of the outliers. And I think statistics will just show that it seems like that this is like, because we're investing so broadly, so diversified, it's just more or less a given that we have always some outliers in our portfolio. But where the outliers are created, that's very random. That's, for us, it's unexpected. Right, so the biggest outlier we had in our portfolio was from Romania. No one in the world expected a company like that from Romania. The second biggest if you look at the next outliers, it's the same thing. No one expected this kind of outlier when they invested in. So for us, randomness is very, very important. We don't believe in like the hyped VC model or the hyped founder model. So typically it's not the super hyped founder who is the most successful, but it's probably the more resilient, in the beginning at least, not very like seen, visible, hyped founder who becomes at some point very hyped, but at a later stage, at a Series A or Series B.
Yeah. So actually Guy Kawasaki had a quite interesting saying. He said like, VC is a stupid game. You invest in 20 companies. 3 out of 20 performed better, and then you blame your stupid partner for investing for the rest 17. So,
yeah. Well, we do a lot of solo GPs, so they don't have a stupid partner. It's all their own responsibility, I think.
So back to the Romanian case. So do you still remember like the early days talking to the Romanian GP?
The real big differentiator was that it's one of the first VC funds in the region. So what we thought is, and it was one of the larger ones in our portfolio. So what we thought is, okay, this fund, they can cherry pick in the region any company, because usually there is no one else in the very, very few funds, regionally very few funds, and from outside of the region, no one really looked at, companies in that region. So they were like one of the few looking at companies. So the competition was more or less zero, and they could cherry pick the right companies. Not only did they cherry pick the right companies, because there was no Series A and Series B money available in the region, they also doubled down without any competition at low value, relatively low valuation. They increased their ownership, and they ended up having ownerships like 30, 40, sometimes 50% in the companies, which is very unusual for a $150 million fund, right? Exactly. Usually if you have a $150 million fund in UK or Germany, you end up maybe having 10 to 15% ownership after the Series B, right? But not 50, but not 40. So that was like a very exceptional time and situation, and we always believe that fund size or ownership is related to fund size. So usually the ownership is relatively low for 150 million funds, but if the ownership is 3 times of the average 100 million, 150 million fund, then the fund can also be larger because they hold 3 times more ownership, right? But but today it's not possible anymore. Right. Today you have 50 funds in the region. Everyone else outside of the region, including the US, because of these outliers, would look at any Series A company that seems to be relevant. So there is lots of competition in the region. So completely changed, but that's the background of why we invested in that fund. And that's almost 10 years ago now.
Yeah, I guess they also won out because they were like one of the earliest, and now it's like low-hanging fruits gone, and everything gets more competitive. VCs even outside the region start to look at or focus on the Eastern European part of the world.
There's another trend. 10 years ago, most of the founders raised locally. Today, if you're a great founder in CE, you are able to raise from the US, from Europe, Western Europe, so you don't have to raise locally anymore. So it's even, it's even harder today. Even if you are a good fund in CE, you still have to compete against strong brands outside of CE. I think that the situation changed. We still believe that CE is one of the most important regions, and but the model is now back to very small funds who are very focused and invest into the right companies at the earliest stage, and don't really follow on in the companies, because the follow-on capital for strong companies, even from the CE, is very competitive.
Yeah. So I'm quite curious, like how many micro VC GPs do you talk to each week these days?
So at the moment it's like summer, and you feel there is a summer break, and people are less active, which is good. And I'm I'm going for holidays in the next 2 weeks because of that, because it's a lower activity. But usually what we do is, again, we look at 800 funds roughly a year. That's screening, and we try to talk to 20% of them. So that's 150 to 200 first conversations. And then another 20% out of that, comes into due diligence mode, several talks. So usually, I think every week, maybe 4 to 6 conversations with new funds. That's maybe the right number, roughly.
Right. So what do you think sets a great FOF apart? Is it like the ability to get into difficult deals, or which is the difficult VCs?
No, it's not getting into difficult deals, in my opinion. It's getting into, or have a kind of unfair advantage, finding the deals that are probably not understood by most others. This can be regionally having very early stage access to founders, or vertically. So let's say, 6 years ago, we invested in the first AI fund. So back then, there were not a lot of people who were focused on AI really.
Yeah.
And this guy we backed had a strong background in AI, also strong scientific background. So he was like really finding the companies and the founders that no one else really understood and looked at. And I think that is probably the most important thing, how you set yourself apart from the rest, finding a niche which is a very good fit to your background and what you want to do, and then building a brand around that niche for yourself and your fund. So if others say, if you're talking about consumer, you should speak to this guy because he's like the one really investing into consumer tech at the earliest stage. If people around, founders and other VCs, say something like this, I think that's the best way to differentiate compared to most other funds who try to be generalist and try to do everything everywhere. It just doesn't work, in my opinion.
But I guess like 6 years ago, you also didn't expect the magnitude of growth of that AI fund, because like AI is just experienced like the paradigm shift.
Yeah, so that's what I said about randomness. So we did this kind of bets also in other areas, but AI was the only that had this, where something happened in the last 6 years. Now, will this happen in a broader way in the portfolio as well in terms of returns? We don't know yet. It's still too early, right? The whole perception of AI changed, but it doesn't mean that many companies who implement AI will be super successful. We don't see that yet. But to give another example, we've also invested into a quantum computing fund, right? Quantum computing focused fund.
Yep.
Now this could be also the next paradigm, right?
Sure.
Shift. So we don't know. And because we don't know, we don't have an opinion. We are super agnostic and super diversified. We have quantum-focused funds, we have AI-focused funds, we have several deep tech-focused funds, we have life science-focused funds, we have synthetic biology-focused funds. So we think we don't know what the next thing will be and where the next outliers will be. And that's why we try to pick in each area when we see the right GP background with the right fund size and right focus. We think, okay, that's investable for us. That's another bet in another region, in another vertical where we want to do a bet. We don't know the outcome. That's the random part,
So what will be a sweet spot of a fund size for you to invest?
So we always say like the number that we communicate is 5 to 50 million.
That's a large range.
Yeah. The sweet spot is probably between 10 and 30, right? And sometimes it depends. So let me explain what it depends on. We want the fund to be able to invest either in their focused region or focused vertical. Most of the capital pre-Series A.
Yeah.
Okay. So if you are able to invest a 30 million fund in your region, let's say you want to invest in 20 to 30 companies, if you are able to deploy that money in the region or in your vertical, pre-Series A means pre-seed seed. And let's say our expectation will be like something like 80% pre-seed seed and 20% reserves. That's like the general number that we would like, if you ask me about a fund size. Now, if that works, if that realistically works, that is a perfect fund size for us. Now, if you want to raise a 70 million fund and want to do pre-seed seed, and we expect you to deploy 80% of that money at pre-seed seed, means you have to deploy something like 50 to 60 million at pre-seed seed. Sometimes this can be very difficult, right? And what happens usually is that people not only not focus 100% at pre-seed seed, but do also more in Series A, reserve more capital because they can't deploy it, and that has a negative effect on your multiple. And so that's the real reason or explanation why we think, larger funds, we want to avoid larger funds. But if we see a great fund that is 60 million or even 70 million and can deploy most of that capital because it's such a niche, such a vertical, such a region maybe, where, again, the example of the Romanian, the Eastern European fund, if we see something like that where there is a niche where they can deploy most of the capital very early stage, it could be a slightly larger fund. That's like That's the exemption. We do in each fund, we have probably 1 or 2 funds that are above 50 million.
But let's say we have a made-up fund, which is targeting Italy, a quite undigitalized country. And for example, like it's a AI focused, okay? Now AI and Italy. And what kind of optimal fund size would it be like if it's a pre-seed, seed 80% fund?
It will be a no for us in this case, because like if you're vertically focused and regionally focused, the deal flow would be too small, right? So that's like the general answer. But let's say if it's an AI fund out of Italy investing into Europe, first of all, you have to make yourself a brand that you are really considered the AI fund across Europe and not only in Italy. Because if you're only recognized in Italy, it will be too small, right? The number, except Italy is the AI country. I don't know, probably not, but that will be the real reason. But to answer your question, if someone is focused on a small region or a small vertical, and let's say in some verticals, some of the funds only invest in 10 to 15 companies. In other regions, they invest in 40 to 50 companies. That's how you can, find the real number. So if you are able to invest in 50 companies, and you can deploy on average 800K in pre-seed and seed on average in each company, then this is a fund size of 40 million, right? Deployable capital plus fees, 50 million, something like that, right? If you're realistically able to deploy more than 800K, let's say 1.5 million, which is very difficult, by the way, in pre-seed seed, in my opinion, because you have to be also leading some rounds, or you have to be able to put more money than others. That's where it becomes harder, unless you are really a very very good branded fund, where the founder will give you a larger share. So I think it's always. I'll give you an example. In the UK, rounds are much more competitive than in CE in general still, right? We talked about CE becoming much more competitive today, or let's take Italy. So UK is much more competitive compared to Italy.
Yeah.
So if you are if you are investing into Italian founders, you have much more room usually. You can cherry pick. You have more room. Now it's always the question of if you find the best founders there. But in UK, you have 50 to 100 VCs, and if there is like visibility of a good founder, they have several term sheets. You have to be very good to participate in that round. Not only participate, if you want to participate with a larger amount, let's say 500K or more, you have to be like considered a really good investor. Why would the founder take your money and not the money of other VC funds? That's the question that you have to ask yourself, and that leads, in most cases, realistically, if you want to be focused on performance and deployable capital on smaller funds. And many of our GPs, for example, understand it, and they keep their funds small because they know they can't deploy more money at the early stage.
Right. So also you mentioned lead or follow. So do you have an appetite on invest in lead investors, or you're also okay with follow-on investors?
We're totally okay with follow-on investors, especially if the fund sizes are very small. So if the smaller the fund size, the lower the probability of leading rounds, right? Unless you're investing maybe in the
only focusing on pre-seed.
Earliest stage. Yeah, exactly. Even like incubation stage, very early angel kind of investments. But other than that, we don't have a big preference. I think the smaller the funds, the more co-investments they do, or co-investors they are, and the larger the fund becomes, the more they have to be a lead investor to be able to deploy the money that they want to deploy.
On your website, it says out of more than 2,100 funds that you screened, so you've invested in like 50 of them, and resulting in like 1,400 portfolio companies. And also more than 20 unicorns and 1 decacorn. What really sets a seed fund apart?
I'll come back to the randomness, okay?
Yeah.
It is very random. So to explain in other words, the ones we expected to be the most successful were not. And the ones where we didn't expect in the beginning to be probably the most successful became the most successful. It is really a random game. So some of the best branded funds we invested in are good performing funds, but they're not the best ones, right?
Yeah.
And some of the funds that are considered in the markets perceived not great funds, right? Not great teams, not great brands, not great GPs are some of the best VCs in terms of performance. So I just wanted to say the correlation is not very high in terms of outlier, because if you hit an outlier, you're an outperforming fund. Now, hitting an outlier in Romania, probability is higher than hitting an outlier in the established regions like London, for example.
Yeah.
It comes down to the same answer as I gave before. I think the less competition you have and the better brand you have for the kind of investments you want to make regionally or vertically will lead to probably better outcomes in terms of investing. Now, the real outcome is still dependent on what happens in the market. So we don't know if in the next 10 years, maybe life science will become the biggest thing, in terms of outliers, because we as a humanity might need things like COVID is a very good example. And I don't know if you know the company BioNTech in Germany,
yeah, sure,
who made the vaccines. So BioNTech was a life science tech company, right? But nowhere near to be an outlier. With an external factor like COVID, they became one of the largest outlier in that year. So these kind of things can happen, right? And if these kind of things happen, then the next outlier will be created. And that's also another reason why random outcomes are what we expect in our portfolio. We don't know which ones will be the best one and which areas will be the best one.
Right.
Seed funds who set themselves apart from others, again, are the ones that are very focused, that have a background that is a good fit to what they do, who are also good in fund management, means reporting, all the other things that are relevant in doing a fund, running a fund, building themselves a brand among the founder and VC community,
right,
of being the go-to investor either in the region or in the vertical. That's maybe the longer answer to how you set yourself apart.
Understood. That's a great answer. So you must have your guidelines or checklists. So what were the factors you thought to be quite crucial but turned out to be less relevant after years of investing in funds?
Yeah. So in the beginning, we were also, I was a little bit more focused on already branded funds, right? So I was looking to invest into the ones that were already considered a strong brand in the market. And when I was starting, of course, I was based in Germany, so I was looking at German funds. Then the second big nation country was UK.
Yeah.
So I tried to invest in several of them. And then over time, I realized, again, I think today we are much more diversified across region and verticals. We want to identify the brand before the brand is already identified by everyone else, right? So that's sometimes difficult, but we think that's crucial to our work, to identify, let's say if we think you, for example, are very good in doing something very specific, but most of the other market participants don't see that already, especially LPs.
Yeah.
Then this is something where we think we could be one of the first investors in this kind of fund and lead it. It's the same thing with the AI fund I mentioned. 6 years ago, I think back then it was a tiny fund. No one was really convinced, and we were happy of. It's just an example. And again, it could have been the quantum fund instead of the AI fund.
Sure.
Yeah.
So you're saying especially when they are doing something might look hard to others, but which is quite easy for them to do, or they're really good at doing.
Exactly. Harder. If you talk about deep tech in the last years, most VCs claim to do deep tech. Most VCs with no deep tech background don't really do deep tech, right?
Yeah.
They don't understand it well enough, especially in the earliest phase, right? And so if you are able to invest into GPs that understand deep tech, the earliest stage, a lot of people speak about operational VCs, right? People who work before as founders, before they start investing.
Right.
Someone who has founded a company, raised capital, worked in a very specific area is probably, has probably a better level of communication with the same kind of founders and understands better the needs, etc. But it does not mean that they are good investors. So it's very important, right? So a good investor is something very unique. So just because you were a good operational founder does not mean you will become a good investor.
Yeah.
And some of the best founders we have backed have never been operational founders, but they were very good in picking and investing into the right companies at the right time and place. So I think it's a kind of unique skill that we are also looking for. Is someone a good investor? If someone wants to save the world and invest into really impacting things, but is not really in the business for returning capital, right? Then it might be really a great investor in terms of impact KPIs. I'm not talking specifically about impact in general, but it might be not the investor returning capital, focused on returning capital. And also another thing is, I think we try, for example, not to back wealthy GPs. So we think we still need GPs who are hungry or wants to become wealthy. So if someone is already wealthy but wants to be an early stage GP, we think the job is extremely hard to be an early stage GP. It takes 10 to 15 years until you see carry, until you see real performance. In most of the cases, there is a high probability that you will fail, right? So what's the incentive for someone who's already rich to work hard if he realizes the portfolio is probably underperforming? The percentage is very low because he doesn't need to. But if you are dependent on that, if you really need it, then the focus, the alignment between the GP and us is much, much higher. By the way, another reason why we invest in small funds, because the larger the funds get, we talked about it earlier, the larger the funds get, the higher the management fees are, and the less the focus on long-term real results, because the management fee already gives you a great life. So you don't need the carry anymore. If you have a 7-digit salary every year, you can live the life of a millionaire without returning any money, right? I think a lot of larger VC funds and PE funds are in that very comfortable situation where they don't even have to deliver any returns, and they're still living a great life. So we want to avoid that. So most of the funds that we invest in don't have enough management fees to be, to live a wealthy life. They need the carry. They need to focus on performance and return. And only if we are performing, like if the fund is performing, we receive a high return, they will be ideally wealthy individuals. That's like the alignment and incentive that we also need.
Got it. So you want back investors or GPs who are hungry and who are at their growth phases. But regarding the wealthy GPs that you mentioned, but they might also be like the founders who have exited from their previous companies. So once before, they were also poor and hungry for the success of their company. But like their successful exit also brings them brand, and also that attracts more founders, and they've got like a better position to be in talks with founders. So you've got like these two forces, which is counter to each other.
100%. And it's a difficult situation because, as you said, it might be considered already a brand, founder, and still, if we don't see that hunger, and sometimes it's like even though sometimes rare, but sometimes even though they are wealthy, they still have this inner desire to invest. Right? To like invest into the right companies, to back the right founders, to earn still money. So some people are still investment focused. So we see a lot of founders who exited and want to become VC. So that's like, unfortunately, at the moment, it's like a very fancy job for even the exited founder. We also see that some of them have difficulties becoming a fund manager. Like if you have 50 million on your bank account and can do angel investments without raising external money, going into all the regulated funds management world with accounting and tax and everything, sometimes it's too much for this kind of founder, because he wants to invest just into, let's say, great deep tech founders or something like that, right? And he speaks the language, but he doesn't want to speak with lawyers and tax advisors and, these kind of things. So it's really important, and it's case by case, and it's a perfect example where sometimes founders who have exited and become very wealthy are not hungry enough anymore, and some of them are not good investors in my opinion, but some of them are still hungry. I don't know why. Something drives them, and they are still interested in investing and returning money. That's very, very interesting. And we've done 2 or 3 of them, for example, in our current fund, and probably in the previous fund also 1 or 2. And it's very interesting. There's one thing that I have to say. Some of them, of course, have a huge GP commitment as well.
Yeah.
Means that a big portion of their exited amount is going into their own investments. If this is the case, it's already, again, showing some real commitment. Exactly. You need skin in the game. And there are examples where someone has exited and puts a tiny GP commitment and wants to raise external capital to do this risky investments. And this is exactly the moment where we are out of the game, right? So we wouldn't consider an investment. But it's a very good example, by the way.
Right,
it's a very good question.
So I actually found I guess he was the founder of Wunderlist, and then he created Superlist as of now, and you also backed him, right? He also has a fund himself. I don't know if I remember correctly, but like I'm just trying to
we're not
come up with
announcing the funds that we're
yeah.
We're not announcing the funds that we've backed until they had their final close.
Yeah.
So this would be one of the funds that we don't announce. But yes, it's a good example. And we looked at this fund, and it's exactly the question that we ask ourselves: what drives them? Are they really still, hungry? Are they good investors? And in this case, I think they are good investors. At least one of them. So, but time will tell. I mean, the kind of commitment, like there is a Turkish saying that whatever someone pretends to be today, or only time will tell you the truth. So you have to wait to see the real, the real truth. You can't know it at the moment. It's just kind of feeling, and it's still taking a risk, a risky bet. In each fund, every fund we invest in, there is some risk involved, and this is maybe the risk in those funds where there might be no real incentive anymore if the fund is not really performing. Right, that's our risk.
Sorry, I have to get rid of my dog. He's quite annoying here. Get out of here.
At least
please.
He's not loud.
He's not loud. He's a husky, so he doesn't bark or anything. But he just wants to stay
beautiful.
Close with me. Yeah. I mean, I've never seen a husky in Europe. I've spent 3 years in Europe. I've never seen one, actually.
Oh, they are. You have to come to Germany.
I've been to Germany. I've lived in Berlin for like a year. I worked there. So I didn't go to the right part of Berlin.
Huskies are not, I don't know, I don't have a dog, but I would say huskies are not the right dogs for the cities, right?
Yeah.
If you have a husky, you should be probably in a rural area.
Yeah, so we are releasing him during the road trip.
Oh,
Bye.
yeah, great.
Bye.